Laurie, fantastic to catch up with you. Let's just walk through that. Are we seeing that natural breather right now, or are we queuing off some fragile data from states like Texas, Florida and Arizona?
I think it's a combination of both. I think Kaylee used a great term, evaluation reality check. Our numbers show us extended on both this year's numbers and next year's numbers, and frankly, we think next year's numbers are too high. But one of our concerns about this market is that even though we've been on this ferocious upswing since March 23rd, and really since the second half of May, it has felt very fragile. It has been very news flow driven. We got very good news on the vaccines and reopening in the second half of May, which really helped fuel that last big move that we had. And guess what? We are getting concerning data coming out about a second wave of the virus. Today, we're also seeing that not all economic data is going to come in and surprise to the upside, as it seemed to have been doing the last couple weeks. So I think it's a combination of just valuations made us vulnerable to bad news, and bad news that the market cares about has been hitting. So it's a little bit of an imperfect storm here.
Laurie, when you look at the pandemic data at the moment, what are you dialed in on? The stability on the headline number, or the disparity beneath at a state-to-state level?
So one thing that we've been tracking on my team, and we've been doing this for a while now, is just looking not so much at the overall statistics, but looking at how the New York region, so Connecticut, New York, New Jersey, have been trending in terms of new cases versus the rest of the country, and sort of X that particular region. And it's been pretty clear to me for a while that the decline in the overall data, sort of that improvement in the national data, has been driven by improvement right where we're sitting, John, and that we've been worried that you would see sort of a second wave hit in other parts of the country, and that seems to be what's happening now. Now, that's not to say it's necessarily going to be out of control. There's a lot of uncertainty here, and like you, I'm not an epidemiologist, but I do know that consistently markets have said they wanted to see a decline in the number of new cases for this market to get stability. We were having that for a while. Now you're starting to see some trouble pop up.
Let's talk about areas of vulnerability at the moment and reflect on the outperformance we've had and where that outperformance has come from. Small caps over large caps, value over growth, international over the United States. As you look at those things right now, the performance through the last month or so, Laurie, where's vulnerable?
So, one of the things we haven't really been inclined to chase has been the value trade. And I'll clarify and say I'm neutral growth versus value on a 6 to 12-month view. But I've really been fighting back against this idea that now is time to jump on the value bandwagon. And I say that as someone who's a value investor at heart, so it's sort of painful for me to say that. But when you look at the components of what has been leading that value charge, it's been things like energy, it's been things like financials. And I've really doubted the sustainability of that financials outperformance in particular, just because of this idea that interest rates are going to stay low for a very long time. I really took away from Powell's press conference yesterday that that's exactly what we're facing. I think he also gave a very sobering look at the economy. So something else I've told investors is what waits us on the other side of this initial rebound. I think it's going to be more of a sluggish economic growth backdrop. Low rates do not favor financials, so therefore they cannot favor value. And if we're looking into the sort of a longer-term sluggish economic growth backdrop, that favors secular growers, as much as I hate to say it. So I've told people, if you want to chase something that's been running, chase the small caps. They're at historic valuations versus large. But I've really been pushing back against this idea of just chasing the value trade.
Within value, Laurie, let's just distinguish between a couple of things. I'm in a decent position to gauge where the consensus lies just based on how many people come on this programme and what they like to talk about. So many people have talked about being long the financials. I hear less about the industrials. You're fantastic at looking where the flow is going, where the positioning is. What does it look like in the industrials at the moment?
So in terms of industrials, that's the one piece of the value trade I do actually like. And our thesis has been it's just as cheap as financials. It's not dependent on higher interest rates the same way that the financials are. So you don't need interest rates to move up to sort of get that catalyst. These companies have great balance sheets. They're managing their margins very closely. And then if you think about sort of how the society is going to pull itself together post-pandemic, one thing we've talked about a lot is we're going to get back to work a lot faster than we're going to get back to having fun. And so that favors things like industrials over things like consumer, for example. I find that when I talk to clients, it doesn't seem to be that consensus, but they don't really fight against the logic either. I think that financials, frankly, are just ripping, or they have been up until the last few days. Hedge funds have been deeply, deeply underweight that sector, so they felt the pressure to chase there. And I think that's why people are suddenly talking about that space again. But I find on industrials, the views are just pretty balanced there.
Well, the banks are getting absolutely hammered this morning off the back of that flatter curve and lower Treasury yield story emerging in the bond market. I want to talk about earnings just briefly with you, Laurie. You mentioned it earlier on the programme. It's normal to come out of recession and see PE multiples accelerate to pretty extended levels in anticipation that the earnings revisions will come in good time as the year grows older. That's what's happened over the last couple of months. You're a lot more conservative on EPS revisions going into 2021. Why is that the case, Laurie?
So it's really all about the math, John, and we've really been focused on updating our model throughout this whole pandemic, knowing we're not always going to get it exactly right, but we think you have to do the work to figure out what the vulnerabilities are. And as I go through and look at my numbers versus consensus, so consensus is coming in at 163 for next year, right back to 2018 and 2019 levels. That doesn't pass the smell test with me. I think we're going to have to take a lot longer to get back to normal. But even when we run the math, I still only get to 149, and I do that by baking in the V-shaped recovery that everybody's talking about. So I'm sort of struggling with understanding where people are getting, back to normal when my own modeling, which is baking in that consensus recovery assumption, isn't getting there. Now, I'll tell you the one thing that's really different between my number and street numbers is that I have margins next year staying significantly lower than they were back in 2019. And what we find in the consensus numbers, people think that margins are just going to go back to where they were. That just doesn't seem realistic when I hear about all the things that companies are having to do to keep their workers safe, to increase sort of the work from home capabilities of their employees. Companies are spending a lot of money to get through this, and I don't think that all those costs are suddenly just going to go away. Yes, they're good at managing costs, but the idea that things are just going to go back even on the profitability side and the margin side and the cost side to where they were, again, it just doesn't pass the smell test.